Hey, have you ever wondered how the world's greatest investors, the legends, find those incredible once in a lifetime companies? It kind of feels like some secret code, right? But what if I told you it's actually a process, a system, one that we can follow? Well, today we're going to crack that code together. So let's get right into it. How would someone like, say, Warren Buffett, decide if a company is a buy? Well, it's not magic, not at all. It's actually a really disciplined checklist. You see, he's looking for a very specific kind of business, one run by a very specific kind of person, and, this is key, at a very specific price. It's a framework we can all learn from, and today we're going to apply it to a really fascinating company. And our case study for today is Zebra Technologies. Now, you've probably used their stuff 100 times without even knowing it. They're the ones who make all those barcode scanners, those rugged mobile computers, the printers that you see powering warehouses, retail stores, and pretty much all of global logistics. I mean, they are literally the backbone of modern commerce. But the big question is it a Buffett-style investment? Well, let's find out. All right, so here's our game plan. We're going to use Buffett's 4 essential checkpoints. First up, we'll look at the business itself. Does it have a competitive advantage? Then, we'll check out who's running the show and if the company's financials are solid. After that, we get to the really important part, the price. And finally, we'll put it all together and make our call. Okay, first things first, the business moat. Now, before we even think about looking at a stock chart or a balance sheet, Buffett says we have to answer one simple question. Is this a truly great business? One that can actually protect itself from competitors for years and years, maybe even decades? And the key idea here is what he calls a durable competitive advantage, or more famously, a moat. Just think of a medieval castle, right? The big, wide moat filled with water is what keeps invaders out. It's the same thing in business. A company's moat is what protects its profits from all the competitors trying to storm the gates. So, does Zebra have a moat? Oh, yeah. It's wide, it's deep, and it comes from three main things. First, really high switching costs. I mean, once a giant warehouse builds its whole operation around Zebra's system, trying to rip it out and replace it is an absolute nightmare. Second, their brand is like a fortress. They're the trusted go-to name in this space. And third, they've built this amazing ecosystem. It's a one-stop shop for everything you need to track your stuff. You put all that together, and you've got one powerful moat. Okay, so we've checked the first box. Zebra is a great business with a strong moat. Now, let's move on to our next checkpoint, management and money. Because, let's be honest, a great castle doesn't do you much good if the people running it are clueless, or if there's no money left in the treasury, right? One thing Buffett is absolutely obsessed with is something called rational capital allocation. It's just a fancy way of asking, are the bosses using the company's cash wisely? And you know what? Zebra's management gets a huge checkmark here. Instead of chasing silly fads, they made this massive, game-changing bet back in 2014 when they bought Motorola's enterprise unit. It was a super bold move that made their moat even wider because it doubled down on what they do best. That is exactly what you want to see. And what's the result of all that smart management? Well, just look at this number, 22%. That is Zebra's 5-year average return on equity, or ROE. Basically, it tells you how good management is at turning shareholders' money into actual profit. Buffett loves to see companies that are consistently above 15 to 20%. Well, Zebra clears that bar, and with room to spare. And when you look at the whole financial scorecard, it is just a clean sweep. That awesome ROE we just talked about? Check. Pass. How about their debt? Super conservative. Even after that huge acquisition, they managed it down so smartly. So that's another pass. And their profit margins? Stable, healthy, yep, another pass. Financially, this company is an absolute fortress. Okay, let's just recap for a second. We've got a wonderful business with a wide moat, it's run by smart people, and its financials are fantastic. So, this has to be a slam dunk buy, right? Well, not so fast. We've now arrived at the final and maybe the most crucial test of all, the price of quality. Because the question is this great company available at a great price? To really get this, we have to understand Buffett's single most important rule. He calls it the margin of safety. And his analogy for it is perfect. Think about it. If you're building a bridge and you expect 10,000-pound trucks to cross it, you don't build it to hold 10,000 pounds. No way. You build it to hold 15,000 pounds. That extra capacity, that is your margin of safety. And in investing, it means buying something for way less than what you think it's actually worth. It gives you a cushion, just in case you messed up your calculations. So, what does that mean for Zebra? Well, the whole story is right here on this chart. Our analysis tells us that Zebra's real value, its intrinsic value, is probably somewhere between, say, $290 and $340 a share. But now look at where the stock is actually trading today, right around 320 bucks. It's smack dab in the middle of our fair value range. There's just no discount. There is no margin of safety. And that brings us to a phrase that perfectly sums this all up. What we have here is a wonderful company at a fair price. See, the market isn't stupid. It sees how good Zebra is, and the price reflects that. Now, paying a fair price for something isn't a bad thing, but it's not that grand slam home run that a real value investor is always hunting for. All right, so we've run Zebra through all four of Buffett's checkpoints. We've looked at the business, the management, the financials, and the price. So where does that leave us? It's time to put all the pieces together and make a final call. Is it a buy, a hold, or a sell? And the verdict is a hold. Here's why. If you already own shares of Zebra, congratulations. You own a fantastic business, and there's absolutely no reason to sell it. But, and this is a big but, for a new investor thinking about buying in today, that lack of a margin of safety is a problem. The current price just isn't that attractive. Simply put, you're not getting a bargain. The really big takeaway from all of this comes down to a simple three-step logic. Step one, Zebra is, without a doubt, a super high-quality company. It passes the first two tests with flying colors. Step two, the market sees this quality, and so the stock is priced fairly. And that leads us to the single most important lesson. Step three, a great business is not always a great investment. The thing that separates the two is the price you pay. And so that leaves us with one last big question to chew on. When does a great company like this become a great investment? The answer is simple, but it's not easy. It's when the market gets scared. When there's some short-term panic or bad news and the stock price falls way below its real value. That is when the patient, prepared investor gets their opportunity.